Welcome to the Explainer. So imagine waking up tomorrow to find that every single dollar sitting safely in your savings account is secretly losing value. Sounds a bit alarming, right? Well, that is exactly what's happening to millions of people right now. Most of us are taught from a super young age that putting money in a bank account is just the ultimate responsible thing to do. You work hard, you save consistently, and you literally just watch that balance tick up over time. But here's the catch. While your bank balance might be numerically increasing, your actual purchasing power could be quietly shrinking right under your nose. Okay, let's dive into this explainer and uncover the fascinating strategies the wealthy use to deploy their capital for massive growth, instead of just hoping traditional savings are going to be enough.
Here's our roadmap for today. We'll be looking at 1. The savings illusion. 2. The bank's playbook. 3. Assets versus liabilities. 4. The wealthy portfolio. 5. The power of compounding. And finally, 6. The mindset shift. Let's get right into it.
We gotta start by asking this kind of shocking question. Is your savings account actually losing value? It feels deeply counterintuitive, I know. You log into your banking app, the number is slightly bigger than it was last month, so you must be winning, right? It gives you this great feeling of false security. But the reality is, wealth isn't about the literal digits on a screen. It's about what that number can actually buy in the real world when you go out to spend it.
All right, Section 1. The savings illusion. Why saving money isn't exactly storing wealth. This brilliantly illustrates the exact problem we're facing here. Let's say the average rate of inflation, the rising cost of everyday goods and services, sits at around 3%. Now, compare that to a standard traditional savings account paying out a 1% interest rate. Your money might look perfectly safe, tucked away in that account, totally shielded from the stock market and the outside world. But the math? The math tells a completely different story.
Math doesn't lie, right? 3% minus 1% leaves you with an invisible 2% net loss in your purchasing power every single year. Your cash is essentially an ice cube just slowly melting on the counter. And the wealthy understand this underlying mathematical principle better than anyone else. They know for a fact that cash sitting entirely idle is a guaranteed, mathematically proven loss over a long enough timeline.
To see this invisible threat in reality, all you need to do is look at how the prices of things we need every day drastically inflate over time. A gallon of milk that cost $3 just a few years ago might cost $5 today, and a house that sold for $200,000 might now be listed for well over $400,000 in the exact same neighborhood. Prices inevitably rise, and if your money isn't growing faster than those rising prices, you are actively falling behind the curve.
Moving to Section 2. The bank's playbook. How banks actually profit from your deposits.
Okay, here is a step-by-step breakdown of a reality many people never really think about. When you deposit your money into a savings account, the bank doesn't just lock it in a dusty vault with your name on it. No way. Instead, your money immediately becomes part of a massive, highly efficient lending system. The bank takes your deposited funds and immediately uses them to issue auto loans, home mortgages, and lucrative business credit lines. They pay you that tiny 1% interest to keep you happy and feeling secure, sure, but then they turn around and collect 7, 8, or even 10% from those borrowers. They're actively leveraging your capital to build their own wealth.
This leads us to a totally foundational realization. Average Americans save while wealthy Americans own. Instead of allowing the banking system to earn the lion's share of the return on their capital, the wealthy actively seek out opportunities to be the owners of the systems themselves. They basically refuse to be passive depositors, letting someone else leverage their money for major profits while they absorb that invisible tax of inflation.
Section 3. Assets versus liabilities. The real secret of wealth building.
It all boils down to this incredibly simple yet absolutely vital contrast in personal finance. Assets put money into your pocket. Liabilities take money out of your pocket. It really is that straightforward. Rich individuals focus obsessively on acquiring assets, things that can generate steady cash flow and appreciate in value over time. If it's constantly draining your resources, like a shiny new luxury car with a massive monthly payment, yeah, that's a liability. But if it's paying you every single month, like a well-managed rental property, it's an asset.
I absolutely love this concept. Instead of hoarding cash, wealthy individuals deploy their money. They view every single dollar to their name as a dedicated, tireless employee. And what's that employee's main job? To go out into the market and relentlessly recruit more dollars. When your money is just sitting in a low-yield savings account doing nothing, your quote-unquote employees are basically sleeping on the job. The wealthy ensure their capital is constantly awake,
constantly working and constantly multiplying.
So, Section 4, the wealthy portfolio. Where does the money actually go?
Well, they strategically allocate their funds across distinct avenues, like these, to ensure they participate broadly in economic growth. First, stocks and index funds allow them to own fractional pieces of highly profitable global companies. Second, real estate provides a really powerful dual benefit of monthly rental income and long-term property appreciation. Third, owning scalable businesses offers them virtually unlimited upside potential and incredible leverage. Fourth, they dip into private equity and alternative investments for substantial, albeit slightly riskier, returns. And finally, they utilize high-yield cash management for the operational funds they actually do need to keep liquid. It's this whole diversified ecosystem designed so that if one market dips, another is right there to catch the momentum.
Notice how tiny that slice for cash is compared to deployed assets. The wealthy don't hate cash. Far from it. They simply understand its highly specific purpose. They keep only a small proportion of their net worth highly liquid for immediate emergencies, sudden investment opportunities, and day-to-day flexibility. Cash is viewed as a vital tool for security and maneuvering for sure, but they know with absolute certainty that it's not a long-term wealth-building strategy on its own.
On to Section 5, the power of compounding. Time as your absolute greatest ally.
You know, there's this quote, famously attributed to Albert Einstein, stating that compound interest is the eighth wonder of the world. Whether he actually said those exact words or not, the underlying principle is universally respected by top investors around the globe. It perfectly captures how returns generating even more returns acts as an unparalleled force for exponential growth. Your money makes money, and then that new money starts making money too. It's exactly like a snowball rolling down a seemingly endless hill, gathering mass with every single rotation.
Let's look at a quick comparison to really ground this math. We have person A who meticulously saves $500 monthly in a traditional low-interest account. Then we have person B who takes that exact same $500 but consistently invests it into assets with higher long-term returns, like an index fund. Over a few months, or even a year, their accounts might look remarkably similar. But over decades, the wealth gap between the static saver and the active investor becomes massive. We're talking the difference between tens of thousands of dollars and literally millions of dollars. Why? Because compounding means growth accelerates dramatically when time is heavily leveraged in your favor.
Finally, Section 6, the mindset shift. Thinking like an owner. Notice the really powerful contrast here. The average mindset, which is rooted in scarcity, constantly asks, how can I save money? They focus primarily on clipping coupons, obsessively cutting everyday expenses, and finding ways to spend less. But the wealthy mindset, that's rooted in abundance, and it asks an entirely different question. How can I grow money? They don't ignore their expenses, obviously, but they channel the vast majority of their creative energy toward increasing their assets and expanding their active income streams.
And it goes even deeper than that. The average mindset is entirely built around exchanging time for money. You work an hour, you get paid for an hour. If you stop working, well, the money stops flowing. But the wealthy mindset is relentlessly focused on building systems that generate money even when they aren't physically present or actively working. This philosophical shift changes absolutely everything. It transforms money from a static, fragile resource that you just nervously protect in a savings account into a dynamically active tool meant to be deployed strategically out into the world.
So, what does this all mean? The ultimate takeaway here is this. The primary goal is to make your money work just as hard as you do. Savings accounts definitely serve a crucial purpose. You absolutely need that liquidity. You need that emergency fund to sleep well at night and handle life's curveballs. But leveling up your financial strategy means looking way beyond the bank vault. It means ensuring the bulk of your hard-earned money isn't just sitting completely idle, slowly shrinking against the invisible force of inflation. We're going to leave you with this provocative question to ponder today. What's the biggest financial lesson you have ever learned about building wealth? Take a moment to really think about your own financial strategies. Are you acting like a passive depositor, or are you acting like an owner? We hope this explainer has sparked your curiosity and inspired you to re-examine exactly how you deploy your own capital. Thanks so much for learning with us, and we'll catch you next time.